What's up, everyone? It's Caddy with MoneyVest. So I've got a very juicy and interesting video for all of you. So we are going to talk about what is coming up in the week ahead. But more specifically, I'm going to go over September seasonality towards the last week and how next week is going to be very, very, very important for the market. Not only from an economic standpoint, we do have a couple earnings to look forward to, but also from a seasonality and a technical analysis perspective, and also going over the risk and reward and why over the next 2 to 3 weeks actually are going to give us a bit of a window for to dollar cost average into some of our favorite names, some of the shopping list companies, watch list, and of course, calculate our fair values and where we would be buyers. So I hope you guys enjoyed this video. I've got lots of information to break down. Make sure that you drop a like. Don't forget to subscribe to the channel. Link to our Discord and Patreon is going to be down below if you're interested in joining, and of course, getting access to all the analysis, all the member benefits, including the intrinsic value spreadsheets, our fair values, our shopping list, buy and sell alerts, options alerts, trade ideas, members only private videos, trading view charts. There's a lot of things. And I'm also going to be introducing research reports starting in October. For all the companies and the stocks that we analyze, members can download a research report like a PDF where you can basically look at my analysis. So link's going to be down below, and we'd love to have you on board. So first things first, I want to talk about one of our members. Shout out to Khalil. He basically posted this in our Discord. And again, this is not my way of... I'm not trying to brag or anything, but I want to help you guys understand the concept and the idea of risk and reward. And that's really what it comes down to when we look at stocks from an investment analysis standpoint, right? I mean, anyone can go out there and buy stocks, right? But when we come to superior investing or looking at it from a different angle, what we're really trying to understand is the risk and the reward in the market at any given point in time. Whether it's today, whether it's a year from now, whether it's a few weeks from now, every time you analyze stocks, you have to look at it from the lens of risk and reward. And this right here is the member who in our Discord, they basically posted this on August 14th, so about a month ago. And this right here was the clip or the message I posted same time last year, literally 1 year ago. So if you go over the entire message and what that message is, this is from September 29th, 2022. Okay, seasonality at that time was at its peak, literally was very, very high. September last year was brutal. I mean, the markets were down so much. So if you come over to our S&P 500 here, so SPX monthly time frame, we basically saw September last year, which was over here. This right here was the candle down over 9%, right? So we almost bottomed literally at 35.87. Of course, October, we did see some more lows at 34.82, so sub 3,500 before kickstarting that rally in the S&P, and of course, rallied a little bit over 31% in the last 1 year. But the bottom line is that September seasonality was at its peak. That month, it was brutal. We were down over 9%. So this is literally what I mentioned same time last year. So we're doing this video in September of 23. This was the post from September of 22. I mentioned that today is the best risk reward dollar cost averaging opportunity we've seen so far in 2022. It's kind of always funny going back to the old posts and published reports and analysis and videos. It's kind of like, it's just hindsight 2020, right? It's just going back and kind of reanalyzing and looking at it from a different perspective. But I mentioned that I will highlight some reasons. Lowest points for the S&P, the NASDAQ, and the Dow. Extremely oversold conditions. Over 98% of stocks trading below their 20-day moving averages. 89% of stocks trading below their 200-day moving averages. Double bottom on the S&P. Bullish reversal chart pattern on the daily, meaning there was a bullish divergence. Volatility is at our target of 35. It was at 34.88 high for the day on that day. Several stocks are hitting new 52-week lows, with many hitting their lowest valuation in a long time. Yields have topped. For now, they can definitely go higher, but if they move lower, that will be a big tailwind for equities. Guess what? They actually have moved higher from those levels. Dollar index topped again. For now, it can definitely go higher, but if it moves lower, that will be a big tailwind for equities. Same sort of thesis. And I mentioned that, remember, the market can absolutely go lower from here, but I'm highlighting the best risk reward. Again, the focus here is on the risk reward potential, and I'm happy to begin the dollar cost averaging process here, knowing fully the markets can still test lower lows as the earnings revision takes place. And again, there's further to it, but that was the whole idea, right? Understanding market dynamics and also focusing on the risk and reward aspect, starting dollar cost averaging in September, literally September 29, 2022. And of course, going into October, that was the window last year, right? Where we were able to dollar cost average, where we were able to take advantage of a lot of deals, where we were able to sell puts, get assigned on those puts. And again, since then, the markets have just ripped, right? In the last 1 year. Now, why am I bringing this up? Because last week of September is usually the worst time for the market from a seasonality perspective. This is why. So this is S&P 500 seasonality chart, and this is the entire month of September and how it basically plays out. And what you'll notice is the last week is when things accelerate, right? Things accelerate to the downside, and we see starting September 23rd, 24th. What is it today? Today is 24th, right? When I'm doing this video. Last few days, last week basically is when the markets accelerate that sell-off even further, and we start to see even more deals and better prices and lower risk and lower prices, right? Things like that. So that's why I'm doing this video now, is to help you prepare for the upcoming weeks, right? Whether it's the last week of September or the first couple of weeks of October, if the markets continues to roll over, that's going to give us the opportunity to once again do what? Look at risk reward and look at our dollar cost averaging and of course our shopping list to once again take advantage of it. Now, I'm not saying that that's going to exactly play out because things have changed, right? From 1 year ago at this, in this analysis, markets were at their lowest point in that year. So we had 98% of stocks trading below their 20-day moving averages compared to now, which is significantly less, right? It's not 98%. It's, I think, closer to 80% or 75%. I'll go over that in just a minute, but it's not the same circumstances, right? So although the risk and reward is better today than a few weeks ago, it's nothing near close to what it was 1 year ago. I hope you understand what I'm trying to get across, because it is, again, the analysis of risk and reward, okay? It's not bargain deals like it was 1 year ago, but it's better than where we were 2 weeks ago, right? Before the market started selling off. But of course, if it accelerates to the downside towards the last week, that's going to create even better opportunities for us. Now, one more thing I want to point out is the 10-year yield and the ratio between S&P 500, PE multiple, and the 10-year yield. This is another one of those indicators that I closely watch and pay attention to because it helps us understand what is the appropriate multiple for S&P 500. What you'll notice is that the 10-year yield is now approaching 4.5%. So we are very close to this area. So this right here is, okay, it's not going to let me do that probably. Let's see if this works. Okay, perfect. Nope, it's not going to let me do that either. All right, let's just try it this way. I think now it's going to be fine. So, okay, this right here is where we are for the PE, for the 10-year yield on the S&P, on the 10-year yield. What am I doing? So this right here is going to be 4.5%, right? We're somewhere between 4 and 5% for the 10-year yield. Now, if you extend this line a little bit further, you'll notice that this right here are where the dots scatter, right? Scattering meaning that this is where majority of those dots are for the PE multiple for the S&P 500. This is where we are, right? This is where we would be if the 10-year yield was at 4.5%, which is where it's right now. If you scroll down, right, go on the x-axis, where does that end up? Somewhere between 15 and 20, right? That basically tells us that, okay, when the 10-year yield is at about 4.5%, the S&P 500 historically has traded most of the times between 15 and 20 multiples. Let's call it 17.5, right? Because that's right in the middle, 17.5. Right now, as it stands for the S&P 500, we're not at 17.5. We're closer to, I would say, 19.5 or closer to 20s. So if I go over to the P multiple now, 4,300 is where we're at. We're closer to 19 on a 2023 basis. I did a fair value analysis on the S&P a few weeks ago, talking about where my intrinsic value would be for S&P 500, and that put us at 4,000. Right? So 4,000 was my intrinsic value on the S&P, right? Go back, watch that video. We did an analysis on the fair value of the S&P 500. That's at 4,000. That's another 6.98, close to 7% pullback needed. Not a prediction that it's going to happen. Again, that's the difference. I want you guys to also understand that these are not predictions. These are levels needed in order for something to trade at its intrinsic value, right? So if S&P 500 now comes down to 4,000, guess where we would be? 17.7. That would be appropriate given the 10-year yield trading at 4.5%, the chart that I just showed you guys in the previous slide. So that would come down from 19 to 17.7, and that is when I actually plan to begin the process of, once again, dollar cost averaging a little bit more, being more aggressive in the buying that I'm going to be doing, so more heavy with respect to individual stocks and more on an aggregate basis as well. So hopefully this gives you a little bit of an understanding on how I go about kind of analyzing the risk and reward, kind of taking a temperature of the market, something that's been discussed in Howard Marks' book the most important thing. We've done an analysis and a book review of that on our MoneyVest Reads channel. So make sure that you check out that video as well. But it's just understanding, where we are in the current market circumstances. And in my opinion, we're not at bargain deal levels, but we're also not like super overvalued here, trading at a premium. But of course, the fair value is going to be about 6.5%, close to 7% lower than where we're trading at the moment. Now, 4,300, this is the technical support, as I've already mentioned. So going into the technicals now, switching gears, this is the overall higher high and higher low pattern. Very, very important level to watch at 4,300 going into next week. NASDAQ, 13,155. That's the level that we have already talked about. And going over to some of the other indicators that are important. So 16%. Almost 17% of stocks that are currently trading above their 20-day moving average, right? So 83% of stocks right now are trading below their 20-day moving average. So the metrics that I quoted in our last analysis 1 year ago, over 98%, that number is at 83% right now. So I think there's still some downside here. There's still some potential prices that can come down to our fair values. Let the price come to you, right? Don't chase, attract. Don't pursue, attract. Let the price come to you. So 7%, the moment it gets down to 7%, we're looking at 93%. I think that would be a good level. This right here is percentage of stocks trading above their 50-day moving average. It's right now already sitting at 18%. So in other words, 82% of stocks trading below their 50-day moving average. Again, a breakdown below this would be ideal, would be nice. More stocks trading below their 50-day moving average, coming down to new lows. That's going to give us opportunities. This percentage of stocks trading above their 50-day moving average, this is the entire market, not just the S&P 500, 22%, meaning that about 78% right now are trading below their 50-day moving averages. And again, the lower it gets, the better, especially if it gets inside this green sort of rectangle. Guess where we were back in 2022, right? When we did that analysis, right? This right here, 2022, we were once again in those levels, right? Really, really low levels at sub 17, sub 12% levels, right? Majority of stocks trading below their moving averages. This is going to be S&P 500 stocks trading below 200 SMA, right? A very rare occurrence of times when you would see a percentage of stocks trading below their 200 moving average to be over or less than 3 to 4%, right? Very, very rarely that happens. And in 2022, of course, we were down to this green rectangle, which is under 13%, meaning majority of stocks, over 85 to 87% of them, were trading below their 200-day moving average. 200 is like 200 average moving prices, right? That's crazy. And right now, we're nowhere near close to those levels, 41% only. I think this green rectangle could be an initial starting point. But of course, the lower we get, the better. The lower, the better, right? In terms of prices, as we like to invest at cheap prices, right? Discounted prices. But going over to next week, we've got Costco reporting on Tuesday after the bell. We've got Micron, we've got Accenture, we got Nike reporting. So I will be doing a video on Costco here very soon. I already did a video on Nike, so make sure that you check that out. And in terms of the economic calendar, we do have, of course, the Case-Shiller Home Price Index. We've got the consumer confidence. We've got the new home sales coming out on Tuesday. MBA mortgage applications come out every Wednesday. We've got the durable goods orders. And on Thursday, we've got very important GDP numbers at 8:30 a.m. Eastern. Remember, I did a video earlier talking about how good economic data is bad news for the market because that only reiterates the possibility for a rate hike from the Federal Reserve. So if you get very strong GDP numbers, well, be prepared for that seasonality kicking in over the last week of September. Corporate profits come out during that time. And then finally, we do also have retail inventories, consumer sentiment, international trade and goods, personal income and outlays. That's going to be the inflation numbers the Fed looks at. That's the PCE, the savings rate. All those things come out at 8:30 a.m. Eastern on Friday, September 29th. So important week ahead, both from a technical, economic, and earnings standpoint, and not to mention from a seasonality standpoint as well. Bottom line is risk and reward is what we are analyzing here, and we will be ready to take advantage of those deals when they do present themselves. So Discord link is going to be down below if you're interested in joining. As always, happy investing. I'll see you all in the next video.